We've got a great presentation for you today, and we're going to be offering up 1 hour of CPE. So on that note, let me introduce you to my colleagues. So again, I'm Lauren Stinson. Unfortunately, Kathy Shaw could not be here today because, it's cold and flu season. But we also have Peter Bache, Melissa Lewis, Tiffany Rohde, and Tony Conkle, who will help drive today's session on the state and local tax landscape, insights from 2023 and strategies for 2024. So the agenda that we have today we're going to talk about the tax trends for 2023, some of the things that we saw, and really take a deep dive into 6 client stories and lessons learned from the year. And then we'll focus on next year, so predictions for 2024. So here we have polling question number 1 to kick it off. I think that's given everyone time to answer. So on that note, we can move forward. Okay, so kicking it off with the tax trends of 2023. I first wanted to address the sales tax trends that we've been seeing. So first off is, sales tax has really become quite a kind of a hiccup in the M&A world. So a lot of companies going through transactions suddenly find themselves suffering from sales tax missed obligations when the due diligence team is doing their tax review. So that is definitely one of the trends that we've seen. So if your company is looking to have a transaction in the future, certainly want to make sure that sales tax is up to date. Another large trend that we've started seeing are around sellers that are selling on multiple different channels, such as they're selling on various marketplaces. So they're selling on Amazon and Walmart, and they have their own website. They may be selling directly to wholesalers. So selling on a variety of different platforms, which give rise to multiple different sales tax obligations, and just really keeping it all put together and straight, and knowing what all they have obligations for and what they don't. The next trend that we're seeing is the rise of more and more marketplaces. So marketplaces now seem to come in all different shapes and sizes. You can pretty much buy anything on a marketplace. It started with kind of that original Amazon, and now there's marketplaces that sell everything under the sun, including services. So that's a complicated trend that we will dive into a little bit more during our webinar, but that is a trend that we are seeing. Same thing with remote workers creating nexus. So as the work from home movement continues, it doesn't seem to be going away. Those remote workers are creating a lot of sales tax obligations for companies. So very important to keep up with where all your workers are to make sure that you're on top of the sales tax obligations. Another trend that we're seeing is really the pace of change regarding electronic services. So SaaS, information services, data processing, streaming, and really the complexity of trying to characterize that revenue to determine taxability, especially when they are bundled with multiple different services. So one of the trends that we're seeing is really just around the pace of change of technology and the lack of pace and guidance from the state. So there's just this big disconnect between the products and services that are offered and tax rules to help guidance on determining taxability. Economic nexus, certainly that's been in the forefront for 5 years because of the Wayfair case. We would think that we would start to see some calming down effects of economic nexus, but it's still going in full force. Some of the interesting trends that we did see this year are some of the states eliminating that transaction count. So many of the states started out with a 200 transaction count. They're eliminating that and just focusing on a sales threshold. So that's another important thing to keep track of, to make sure that if you have economic nexus, you have it for the right reasons. And then the last trend is just that continued trend of exemptions around necessity products. So I think this is a way that the states are trying to create a more holistic tax code to really only be taxing, to not be taxing things that are absolutely essential. So those are some of the tax trends that we've seen for the year. Some specific tax changes that we saw, in Florida in June, the communication tax applicable to streaming and downloaded courses or instructional videos had changed and is now taxable under the communications tax. Mississippi provided guidance that SaaS, if it's provided on servers outside the state of Mississippi, are not taxable. So that was a good, not exemption, but a good advanced option for residents of Mississippi or companies in Mississippi. Kentucky did introduce a lot of taxable services in the middle of the year. So a whole slew of different services, including SaaS. So that was one of the big tax trends that we looked at for the year. New Mexico is one of the states that did provide some guidance on tax obligations for sales required from a marketplace. An interesting trend that we saw in Texas was getting very aggressive, saying that sales of SaaS created an in-state presence, but they seem to back down, saying that the sale of SaaS does create nexus. So they have backed down from that position. Upcoming, we got Georgia starting in January starting to tax digital goods, and Minnesota come the middle of the year will start implementing a retail delivery fee a la Colorado. So those are some of the state-specific changes and upcoming things that we thought were, pretty impactful for the year. And on that note, I'm going to turn it over to Peter to talk about some of the trends for 2023 in income franchise.
Thanks, Lauren. I'll be jumping in on this one. Hi, I'm Tony Conkle. So a few trends and observations that we've noticed on the income and franchise tax side for 2023. Hardly a trend is most states have adopted some kind of market-based sourcing for the sourcing of revenues from sales other than tangible personal property. But we're kind of seeing, every year, a few more states that previously had an established cost of performance sourcing methodology, now becoming market-based states. West Virginia became a market-based state in 22, and Idaho beginning for tax year 2023. Another thing we're seeing is when it comes to past serenity tax elections, some of these states that may have already enacted and established some of their past serenity tax elections are kind of circling back with legislation to fine tune and offer a little more flexibility to their elections. Notably, some of the states that had some very restrictive ownership requirements, like Minnesota, North Carolina, Virginia, and Georgia too, where if say like a partnership had any entity owner, so a tiered partnership situation, even if they might have only been a 1% partner, the entire entity would be disqualified from making the election. So these are states that, as originally enacted, had these pretty harsh ownership requirements, have now made amendments to their legislation to offer more flexibility and allow a larger number of different pass-through entities to make elections. Also, some states just making some of the different processes they have a little bit easier on the compliance end. Louisiana. Louisiana is just an example of a state that originally, like a pass-through entity made the election, would be locked into that election every year until it was revoked. However, the revocation process to stop the election took a private letter ruling request, which is very time consuming, and would probably require a tax practitioner and some fees to handle that process just to get out of an election. Louisiana now will allow for an automatic revocation through a form if it's filed, within 60 days of the end of the tax year. So to make that process a little easier and a little more streamlined. Some other trends of states that we're seeing, establish some bright line economic nexus thresholds. So these would be, coming out of around about 2 decades ago, the multi-state tax commissions proposed rule on bright line nexus of 500,000 in sales, 50,000 of property payroll, or 25% of an or more of an entity's total property payroll or sales. Maine was the state that established this in 2022. However, now we can say that there's more than one state, so it could be a trend. New Jersey would be a state that actually adopting a bright line economic nexus threshold below 500,000 and a pretty aggressive number that kind of runs parallel to the Wayfair sales tax economic nexus thresholds of $100,000. Previously, starting 2020, Hawaii was one of the first state to go as low as 100,000. So now we're seeing New Jersey this year, taking a little bit of an aggressive stance, and maybe a prediction that we'll talk about coming up soon might be, well, there are other states, see what happens there and maybe follow suit. Next slide, please. For some different gross receipts and franchise taxes, we're kind of seeing a few of the states that have those, offer a little bit of relief and really increase some of those minimum caps or exclusions, like Ohio's commercial activity tax starting next year in 2024. They've repealed the AMT amount, previously about $100 at the lowest end. They'll no longer impose the AMT, and the gross receipts exclusion will go from 1 million to 3 million, and then in 2025 go up to 6 million. So then the first, in 2025, the first 6 million of receipts wouldn't be subject to the CAT tax. Pretty similarly for Texas, for their franchise tax, they're going to be increasing their no tax due threshold up to 2.47 million, where, usually every few years, Texas would gradually increase that cap up a little bit, but this is a pretty big bump that the first time seeing something much larger than, say, just a slight inflation adjustment there. Additionally, entities that are under that 2.47 will no longer have a no tax due report filing requirement. If they're under that threshold, they still just have their public information report or their group member report, but otherwise that would really be it. They don't have to file that no tax due report anymore.
Thanks, Tony. So from here, we're going to move on to some client stories and lessons learned. And taking a page out of Law and Order, the following stories may or may not be fictional and do not depict any person, company, client, or event. So I'm going to first turn it over to scenario number 1.
Thanks, Lauren. So as Lauren mentioned earlier, we've seen a lot of due diligence coming through the sales tax department here at Sherry Bekaert. And so I picked out 3 companies that we were able to help in 2023 with their due diligence as they went through the M&A transaction. So company A, this is a manufacturer who sells to other manufacturers. They were only registered to collect sales tax in their home state. So we did a nexus review for them and found out that through economic nexus, they had nexus in 14 different states. They only had exemption certificates for their home state. So we did a large outreach, reaching out to about 500 of their customers to get exemption certificates, manufacturing exemption certificates in this case. And we were able to really reduce down their liability greatly as we moved into remediation, doing some DDAs and doing some registrations and prior period returns. And then to finish them up, we were able to set them up through Avalara. That's a process, automated tax filing service and calculation service, so that their rates and their exemption certificates were correctly set up moving forward. When you have that many exemption certificates that you're looking to kind of corral and keep organized, you definitely need some software to take care of that. So we were also able to help Company B. Company B was a technology company, and they purchased 2 other technology companies at the same time. And at the time, both of those technology companies were registered for sales tax in many states. I think they each were registered in about 20 different states, and they had no access to the sales tax accounts in those states through several turnovers through those other companies. They didn't have any logins, in some cases, not even the sales tax ID. And we were able to fill out POAs and contact the states and get the information and get them into those accounts, which was good because tax had been collected through both of those old companies, and no returns had been filed in probably about a year. So we filed the returns and had the company remit the tax. And when that was done, we were able to close the old company accounts and register the new company with new sales tax accounts and get them set up and moving on their way to being compliant. The last company, Company C, is a flooring company, and they were only collecting sales tax in their home state. Although they were installing in many different states across the United States, they did not realize that they had Nexus, that installation services were going to give them Nexus in those states. So we did a Nexus review. We found out where they had Nexus, and then we did a taxability research on installation services, because they also didn't know whether or not to tax the installation services in those other states. But through all of this, we discovered that they had been collecting sales tax in many different states. They didn't realize they had it turned on in their e-commerce platform. They were selling in store. They had a POS system, so they were selling in their different stores. But they were also selling online and had not realized that someone had already turned on tax collection online. So we walked them through a remediation process that included voluntary disclosure agreements so that that tax could be remitted to the states. So as you can see, this is just 3 companies that we pulled out from 2023, although there were many more that we were able to help go through the due diligence process. And as Lauren mentioned, sales tax always comes up, and you never want it to be the last thing you think of right before you hit the closing table, but it often is. And it can be, as you can see, a lot of different elements.
Great, thanks, Tiffany. Now I believe we have polling question number 2. What is your level of state tax knowledge and how it applies to your company? And I hope none of you are choosing, we choose to avoid this topic at all costs. Okay, this should probably give everyone enough time to wrap up the answers. Okay. Moving on to scenario number 2.
Thank you, Lauren. So in this scenario, we had an S corporation client that intended to sell their business. The structure is that the S corp was owned by 1 Virginia resident and 1 North Carolina resident. In this situation, when there is a sale, we often see it kind of structured in tandem as an F reorg, where new co is formed and then old co becomes a subsidiary of new co, and then old co will convert into an LLC. This results in new co selling a disregarded entity, which is treated as a deemed asset sale for federal tax purposes. In this situation, our client had a gain of approximately $100 million. It was mostly attributed to intangibles and goodwill. Historically, the company has only filed in Virginia and North Carolina, but had customers that were located in many states and had recently been profitable. Next slide, please. So the question then becomes, did the company have income tax filing obligations in other states, not only in the year of the transaction, but in prior years as well? Also, if the company is audited in later years in states where the company wasn't filing, those states may simply go after the current operating entity, often with the same EIN for the previous tax withholding owed prior to the ownership change. I think it's important to note that if there is not any tax indemnification in place within the purchase agreement, the new owners could be on the hook for this exposure. As a result, there was a significant other state. There could be other significant other state taxes owed in the year of sale. Generally, in the case of the sale of assets, it's considered business income. Another question then becomes, how should the gain be apportioned? That needs to be addressed. States have varying rules on whether gains or proceeds should be included in the sales factor from an apportionment standpoint, which can change the amount of tax that's owed significantly. So really, to wrap this up, careful planning should be considered on whether to address prior years' exposures, including exploring backfiling of tax returns, voluntary disclosure agreements, and holding back funds in escrow for remediation. And now I will pass it over to Tony to talk through the pass-through entity tax considerations.
So as there's a large amount of gain and it's an asset sale that will be recognized at the entity level, it presents a great opportunity for the opportunity to make a pass-through entity tax election, and through that election be able to get a deduction or a SALT cap workaround to the income tax that would otherwise be subject to the SALT cap if it were paid at the individual level. So with that amount of gain being recognized in 1 year, it would just be a very good opportunity to really take advantage of an election. However, there's a few different considerations to keep in mind, as it's not always just a straightforward, let's make an election and we'll save a lot of money by making a pass-through entity tax election. We had these two states here specifically, as they kind of represent two different approaches states are taking when it comes to resident owners of a pass-through entity that makes an election. So some states take have a regime where it doesn't matter if it's a resident or non-resident, that base of income for the owner is going to be the apportioned amount of income at the entity level. However, there are a number of states that for residents, they have a different base of income, since the residents would normally in their home state be taxed on their entire incomes, that their base of income would be their entire distributive share of income from the entity. So Virginia is a state where residents, that base of income is their entire share of income. North Carolina is the state that originally took that approach. However, starting in 2023, is going to just be an amount of North Carolina sourced income for residents and non-resident owners of the entity. So with that in mind, you're going to have two different bases of income from the entity for an election made in one state. So as an S corporation, the amount of tax paid to Virginia when that election is going to be made is that entire share of income for the resident owner and that sourced amount for the non-resident owner. And depending on their ownership levels and the amount of income sourced to Virginia, it could be the case that even if it's a 50-50 ownership, that there's really more income being taxed with the election for the resident than for the other owner. However, as an S corporation, to not risk any second class of stock issues or blowing your S corp election, that deduction that's still going to be made at the entity level would be deducted and reduce the ordinary income of both shareholders equally. So one thing just to keep in mind with that is with an election, depending on the state and the amount of ownership and the apportionment factors, that not every owner would necessarily benefit to the same extent or follow with the economics of the election. However, in most cases, still everybody might be better off, but those are just some things to keep in mind. Even with partnerships that may have the flexibility of making special allocations that could reflect the economics of the election, it would still require the partnerships to look back to their operating agreement to see that, is it within our agreement to actually make these special allocations? And so amendments may need to be made to accommodate to make those special allocations. A few other things to keep in mind is that for states that have we call like a credit method state, where the tax paid at the entity level, that owner would get a credit passed through to them that they would claim on their individual return to offset their own personal income tax liability in the state. Not all states necessarily provide a refundable or even dollar for dollar pass-through entity tax credit. There are only a couple states that do not offer a full dollar for dollar tax credit, although most do. And not all states, it's entirely refundable. California, Arizona, Utah are just a few examples where that credit pass-through would have a 5-year carry forward. So in that case, especially in the year of recognizing a large amount of gain, you need to think for these owners would say if they cannot use their entire pass-through entity tax credit in a single tax year, would they have enough state source income in the following years to be able to utilize all those credits? Otherwise, they may expire worthless. Particular situations where this could be problematic would be in the case like Arizona, California, and Virginia, as these states have a reciprocal agreement with one another. And typically, like on a person would claim a credit for taxes paid to other states on their resident state return. In these states, for example, a Virginia resident would claim that same credit on a California non-resident return. And so because that credit is claimed before their pass-through entity credit, it would also even further limit the amount of their pass-through entity credit that they would be able to claim. So in that fact pattern particularly, it's just something to keep in mind and pay attention to. And when it comes to remediation options, don't want to miss an opportunity to make an election. It's still, for a lot of states, very unclear if, elections can be made on returns filed after the tax year on late filed returns through an audit or a voluntary disclosure program. I think that's something we could see in the future, more guidance coming out on, but as most states have only had pass-through entity elections for a year or so, maybe 2, we're still not really in a 3 or more look back year period to really have guidelines that really flesh that out, whether on those returns filed in a VDA program, if elections can be made or not. Next slide.
So thanks, Tony. I know that was a lot of great information. On that note, we've got polling question number 3. When was the last time you performed a nexus review? And while you're answering these, I know we have a question or two up in the chat. We will try and answer those as we go, but if we don't, we can get back with you after the webinar. All right, wrapping up polling question number 3. And moving to scenario number 3.
Thank you, Lauren. So this next example is for a company that was very shocked by the exposure that they had as it pertains to sales tax. We were approached by an e-commerce company. They did not have physical nexus anywhere except for New York, where they were headquartered. They were a clothing company. They sold men's athletic clothing, and they sold it in a multitude of states, almost all of the states. So they had hired another provider previously back around 2019 to do a sales tax analysis. And the provider did the analysis and they implemented a tax engine. What the client didn't know is that they had turned on the sales tax collection in a number of states, but did not follow through on the sales tax reporting. This previous provider kind of fizzled out and went away. And so that they were stuck with, they really didn't know what they were stuck with. So one of our clients' main concerns was, their exposure due to their economic nexus, and whether or not they did have any type of sales tax filing obligations. So they hired us to do a nexus review. And as a result, we discovered they had economic nexus in most of the states. Their sales tax exposure due to the economic nexus, coupled with the fact that they had tax collected and not reported, produced a sales tax exposure that was quite substantial. And like I said, they were extremely shocked by the amount of the sales tax exposure. So in order to remediate this sales tax exposure, we did voluntary disclosures in those states that would allow it. Some states, as you may know, will not allow a voluntary disclosure if there's tax collected and not remitted. So what we did is we came clean in the VDA applications, whether it was an application or a letter, and we let the state know about this previous provider and that the company was not aware their tax collection was turned on. We told the state, we've collected approximately this amount of tax between this period and this period. Will you still let us do a voluntary disclosure? And most of the states did allow us to do VDAs. Some of them said, nope, you have tax collected, you cannot do it. So for those states that didn't allow one, we ended up doing historical returns. Of course, we had to pay the penalty and interest, but we still had to remediate the tax, especially because it was collected and not reported. So even though we discovered this, big exposure and underpayment while we were remediating the tax, either through VDAs or historical returns, we did find that the tax settings, and I think Tiffany mentioned this on one of her clients, were not correct. Because the company sold clothing and it's exempt in a handful of states, I think there's about 7 states where it's exempt. They had their tax settings on all of their states as taxable, 100% taxable, even in New York, which was one of their biggest exposure states. So even though we couldn't get that tax back because it was collected, we had to remit it to the state. We fixed it going forward. The only other option with that tax was to refund it back to the customers. And that was not a burden that the company wanted to take on. So we ended up fixing all their tax settings going forward. So they collected the right amount of tax and exempted it in those states where the clothing was exempt. The second issue we found was a duplication of sales being reported on their current and some prior period returns. They had a shopping cart tax software connector, and then they also had a shopping cart extractor turned on, which made the sales coming through to the return double. And we discovered this because the numbers weren't just matching. The sales were double, the tax was double. So they were reporting double the tax in some of the states on some current returns. It wasn't that they had collected it, they were just reporting it double. So we approached some of the states and said, look, we have this issue, and many of the states allowed us to file amended returns, and a few of the states even sent us a refund check back. So this was one of those rare opportunities that you're able to get the sales tax back versus, tax on your purchase side. So out of this project, this went on for a while. It took some time to clean up everything. We learned a lot of lessons, and the biggest one, the most obvious one, is how significant sales tax can be without a physical presence. The second one is to pay attention to the taxability with what you are selling, whether it be, food or clothing or something that has either an exempt status, or if it's a reduced rate or or possibly, a percentage rate off. Also, the very last lesson that we learned was just because you have a tax engine, you still need a human being or a consultant to review the tax settings to ensure that everything is being done correctly.
Great information, Melissa. All right, moving on to scenario number 4.
Thanks, Lauren. So in this scenario, we have a partnership client that hosts a gaming app that users all over the country participate in. So their model is really a SaaS type of application, and they've been growing year over year, pretty much exponentially. They've been a client for a number of years, and in the past, they've only filed in their home state. And that's because the company was generating losses as a partnership. So there wasn't too much emphasis on, filing in additional states where they might have had obligations in the past just because they were in losses. That being said, the company this year was projecting a very healthy ordinary income amount for the first time and be tax profitable. So initially they reached out to us to inquire about obviously Nexus, because they want to make sure that they were compliant going forward. So we helped them navigate with a Nexus review and really determined that they needed to file in about 35 or so states, primarily due to remote workers in various states, as well as exceeding those economic Nexus thresholds. And the thing that's important is that there's no public law 86-272 protection or anything available to this company, because they are a service provider. They're not a seller of tangible personal property. So next slide, please. Yeah, so, and as I mentioned, this is a pass-through. They had about 100 investors, and getting compliant from a state income tax filing standpoint came with its own additional hurdles. For example, states generally will require what they call non-resident withholding. What this is the states hold the entity responsible for collecting and remitting tax on behalf of their owners, especially the non-resident owners. And the thought process behind that makes a lot of sense. It's a lot easier for a state to go after an entity for not being compliant than going after 100 different investors to try and collect tax that might be owed. So to make things more complicated, of course, every state has varying rules on how they implement this non-resident withholding. There's different requirements depending on the types of investors that there are. So depending on if they're a corporation or another pass-through or an individual, they could have different rules on applicability of non-resident withholding rules. Some states either offer or mandate a composite tax filing, and a composite tax filing is just when a group return is filed on behalf of the owners, so that the owners generally do not have to file their own personal return in the state. And then there's also the concept of waivers from withholding, and that essentially is an affidavit or some sort of certification that the owner will provide to the entity to say, hey, don't remit tax on my behalf. I'll take care of my own estimates and tax planning. So to help our client navigate these issues, because there is a flurry of them, we help them develop a tool that summarizes each state's non-resident withholding rules and options, and that allows the owners to kind of select from a drop-down, make a selection for each state that's available and fits their personal tax situation. From that, that information is then collected and then passes through a state K-1 work paper, which will then compute accurate estimated tax payments that the entity would need to remit, and also provides the owners with a personalized statement on how much non-resident withholding, composite, and or entity level taxes that were remitted on their behalf. So really, to kind of sum this up, this is really a great example of one of our clients that wanted to be proactive. in addressing their state tax needs. And, that really allowed us to come up with a solution that really was best suited for their situation. Okay, so now at this point, I'm going to turn it over to Tiffany to discuss the next scenario.
Okay, great. Thanks, Peter. So as Lauren mentioned earlier, marketplaces are really a hot trend this year, especially service marketplaces. We all know Amazon and eBay and Etsy as being marketplaces, but what a lot of people don't think about is the service marketplaces such as peer-to-peer rental, and one of the most popular being like VRBO, just regular rental services, reservation services. So this past year, we were able to help several clients be able to deal with this, because there's some pretty complicated issues when you're trying to identify whether you're a marketplace, and if you are, whether or not you have responsibility to collect sales tax. Some of those issues being sourcing. So who gets the tax? Is it where the marketplace owners are located? Is it where the marketplace buyers are located? Is it where the service is being performed? You can have a multitude of states being involved in the same transaction. You also have to think to yourself, well, who's supposed to collect the tax? Is the marketplace collecting the tax in this case, or is it the service provider that will be collecting the tax? And lastly, services are not taxable in all states. Some states tax services, some states tax a lot of them, some states tax none of them. So that's a big one that we were able to help with this year, is really to be able to identify for some of our clients whether they were a marketplace, and if so, how to handle that moving forward. So on the flip side of that, thinking about the marketplace sellers. So if you're selling on a marketplace and the marketplace is collecting for you, one of the things we helped some of our clients deal with this year was, how do I report that? Do I need to file a return showing that the marketplace is collecting sales tax for me? Do I get a document or any kind of documentation from the marketplace that I'm supposed to provide to the state that shows that the marketplace is collecting for me? And then one of the most difficult ones are application marketplaces. So Google Marketplace, Apple Marketplace. We've had several clients who sell apps, and trying to get any kind of information from Google and Apple is very difficult. As you can imagine, there's very little transparency there. So even just trying to figure out whether or not the marketplace was collecting the sales tax on that 99-cent app, and if so, were they reporting it? Did they need to report something? So it's very complicated. So this is something that we've really been able to help a lot of our clients with this year, because really, I think people don't realize that they might be a marketplace. They only think of the big ones that sell tangible products, not the services that could be provided.
Right. So the next scenario, I believe the last one that we have, deals with the manufacturer and distributor of office equipment. We have a client that we assisted. This is before I started, with some Nexus work years and years ago. So this client, they sell office equipment, and they also have personnel that work for the company that will help install the equipment. They will provide training and sometimes some maintenance at times, and the issue that was faced is really that they didn't have good documentation for travel. So, and this dates back for years. So in talking with the CFO, it was basically understood that we can basically make the assumption that for the most part, anywhere where they have sales, at some point in time, they've been sending people into the state to assist with the training and installation and so forth. We assisted with providing exposure analysis and recommended VDAs just due to the tax and the number of years going back where this client had Nexus. However, there was a lot of competing priorities. The CFO was trying to work through. They just had a limited staff. So this is something that just kind of sat for a number of years, and we would try to revisit kind of every on an annual basis. So as the company decided to wait for the exposure to address it, they actually got flagged by a state during this past year. They received the Nexus questionnaire in the mail. They filled it out, sent it back. The state came back and said, hey, you have income tax nexus based on the activities that they were performing in the state. And in talking with the auditor, they wanted them to go back and file 8 previous years worth of returns. And that's important to note because the statute of limitations never runs when you don't file a tax return. So they can make you go back as far as when they've established nexus. Luckily, we were, I guess if you want to call it luckily, 8 years was the look back period, considering the fact that the records from a travel standpoint were not in good condition. So in theory, the auditor could have maybe pushed the issue more if they wanted to. But this was a painful and costly process. We helped file those back years returns. I believe there was 1 year where we weren't even the provider yet, so we had to go and recreate the federal return and do all that. So it was a long and arduous process, and due to that, not being able to do a VDA meant not only that to go back beyond a 3 or 4 year look back period. They lost that opportunity to do that, but no penalties were abated, and it just landed up being a very expensive endeavor for the company. So with that in mind, they ended up moving forward with some significant state liabilities with VDAs in those particular states to address this and not have to deal with another issue in this fashion. So what I would say is ultimately, if you know that you have skeletons in the closet and you have a lot of state tax liabilities, don't sleep on them. It's only going to take 1 or 2 states to find you, and it's going to create a lot of headaches. So the best thing to do is really to address it when you're aware of them. That way we can assist you clients with things like going back and filing tax returns or voluntary disclosure agreements, whatever makes sense in that situation. And so now we're going to move on to 2024 predictions, and I believe Lauren will be covering the sales tax piece.
Yeah, thank you. Thank you guys all for so much for sharing that great information. As you can tell, the world of state and local tax is very complicated, and we help clients face a lot of very challenging scenarios every day. So this time of year, we always get asked, well, what do we see in store for 2024? So I brought out my crystal ball. Here we go. I can look into it and see what's going to happen in the future. I wish, but since my crystal ball is here, I'm going to look into it. And these are the predictions I have for 2024. And I think it's going to be the year of the audit. I think the states are getting hungry for money, and they're really looking now to, Wayfair's solidly in place, and they're really looking to start auditing companies for, not being in compliance for economic nexus. So they're going to focus on out-of-state taxpayers because those are out-of-state companies, and it's easier to audit companies that are out of state than to raise tax rates or raise the tax base in their home state. So I anticipate seeing a lot of audit questionnaires, also around effective dates. So as companies get registered, there's going to be a lot of scrutiny around the effective date of when they are registering. Because it's, unless you're a new company, it's somewhat unlikely that all of a sudden today you would hit economic nexus, as economic nexus has been around for a few years. So I think there's going to be a lot of scrutiny on effective dates and registration applications, a lot of nexus questionnaires coming out. I know that there's, a handful of states already that they scrutinize as a matter of part of the registration process. So you've got to be able to defend why you're registering today. Speaking of the year of the audit, I think there's going to start to be a lot of marketplace audits. Again, this is a very confusing dynamic for marketplace sellers as well as the marketplace. So I think we're going to start seeing marketplace audits happen. And also market audits of manufacturers and distributors, not so much because they should have a lot of tax collected, but because they should have exemption certificates to document exempt sales. So a word of wisdom there, if you are making exempt sales, sales for resale, make sure that you have all your exemption certificates in place. And then long-term, I don't think this is going to happen in 2024, but sometime on the horizon, states are going to want their money faster. Technology's out there. It's easier and easier to file returns. So states are going to expect their tax dollars more frequently. So, gone are the days of, annual returns or, semi-annual returns. If you're collecting tax, they're going to want it sooner than later. So those are my 2024 and beyond predictions. And I'm going to turn it over for income tax.
Thanks, Lauren. I love the crystal ball here. Let me get that
Here you
for
go.
me, right? I'll have to get one for next year. I didn't know we could bring props. So a few predictions that I think we may see in 2024 and going forward. I think continued adoption of market-based sourcing. That has been a pretty steady one year over year that, as mentioned earlier, another state or two every year you might see adopting some kind of market-based sourcing methodology. With a limited number of states left, I still think we'll start to see more, or could possibly be states adopting some kind of, like Arizona, for example, has like an option, is normally a cost of performance based sourcing state, but for some service providers offers the option of a market-based election that a taxpayer could elect into if they want to. So maybe even seeing some cost performance states strike a balance if not wanting to go full market based, maybe even seeing something like that. Factor presence economic nexus thresholds. Again, while these are, nothing new, in that, original model rule from the MTC came up almost 2 decades ago. It's, been a slow but steady trickle of states over the years that have adopted some kind of bright line threshold, most of which have always been 500,000 or some amount above, like California increases it slightly every year for inflation. Michigan is one state for corporate income tax purposes has been at 350,000 for quite a number of years. So while under 500,000 isn't necessarily something new, I think, especially now with New Jersey this year taking that aggressive $100,000 sales bright line, there could be some other states, just kind of taking a wait and see approach. If taxpayers may challenge that if they're successful, to see, if it works out for them, maybe they may, decide to adopt a similar bright line threshold. And another thing, the MTC's RISE statement regarding Public Law 86-272, and this is their most recent model rule here regarding internet activities that could create economic nexus, which is even some activities such as like after sales support with a customer could possibly create nexus in a state, or having a job board where applicants from another state would submit applications, so that these activities would exceed the protections provided by Public Law 86-272, and subject a seller of tangible property who might otherwise be within the protections of it to lose that immunity from income tax.
Yeah,
so
Tony, I think this is going to be I think one of the biggest ones we're going to see a lot of action on over the next year or two, especially related to internet activities with cookies and so forth. I know a couple of states have already said that they were going to adopt the measures, but I feel like a lot are going to move in that direction, and there's going to be some definite legal challenges as far as the constitutionality of this. So that'll be interesting to see.
Yeah, whether like California and Minnesota through like a technical memorandum from the Department of Revenue. New York, in the next slide, another prediction, their corporate income tax proposed regulations. This is a part of those regulations, and that process has been going on for a number of years that we may see finally adopted in the coming year. PT elections. Now we're at a point where there's only very few states with an income tax that have not adopted some kind of past serenity tax election. At last count, 36 states, and another few that have at least introduced some legislation, even if it hasn't passed yet. But there's only a handful, Colorado, Nebraska, Virginia, that have tried to do some kind of retroactive election. So the SALT cap imposed on individuals from the TCJA started tax year 2028. And so you have Colorado and Nebraska, states that have gone all the way and made retroactive elections back to tax year 2028. So while, those are still fairly new, when those legislations were passed, it still kind of give the departments of revenue some time and heads up to establish those regimes and that, ability to file those retroactive elections. So we're only just recently seeing like Colorado and Nebraska finally having that opportunity to make those retroactive year elections. Both have been like through Department of Revenue website, where there's not like a typical tax form the taxpayer could file. Virginia, another one that we're still waiting on the guidance and the ability to make that election, but would go back to 2021 only. So while, there's possibly a great opportunity for taxpayers there who could, be an owner of a past serenity and make those elections, even those years going back to 2018, the first year of the SALT cap, it may be difficult to actually carry out. There may be a lot of administrative burdens of doing that. So I think a number of states, may also be just kind of waiting to see how that plays out, how many taxpayers actually, want to do these elections, the administrative burdens that might come along with it. And then, seeing these other states do it, the frameworks that they have, I think just like so many other states that have passed PT elections, you can kind of see, well, they, took bits and pieces of other states, their pieces of legislation and things that work. And, it snowballed from there and made some of those later states a lot easier.
Okay, thanks, Tony. I know we're running out of time, and we got one more poll here, so I'll
Okay.
make sure we have time to get to it. But a lot of great information. We wish we had more time to share. But the question is, would you like to learn more about how we can help you moving forward? Great. And on that note, we're going to conclude the webinar, and thank you again for joining us. I really appreciate all our presenters today. If you've got any questions at all, please reach out to Peter, Melissa, Tiffany, Tony, or myself. We're happy to help you, and we very much value your feedback, and we ask that you take part in a short survey, which will appear when you leave the session. So thank you so much for joining. Have a great day.